What if I told you there's a country that survived the Great Depression without a single major bank collapse? A country that avoided the 2008 crash without trillion-dollar bailouts. A country whose banking system has been so stable, even Wall Street studies it in envy. That country is Canada. And this is the story of the world's most quietly successful financial system in miracle history. Forgot. From the economic panics of the 19th century to the Great Depression, and all the way to the 2008 financial crisis, the United States banking system has a history of collapsing again and again. Think about it. 1837, 1873, 1907, then the 1930s, the savings and loan crisis of the 1980s, and of course, 2008. Each time, the result was catastrophic. Billions of dollars vanished. Factories shut their doors. Families were ruined. Meanwhile, just north of the border, Canada watched all of this unfold. Quietly. In its banks, they stayed standing. For over 150 years, Canada has managed to avoid every single major systemic banking disaster that has shaken the world. And it wasn't by luck. It was by design. The secret to this incredible stability began back in the 1800s. It all comes down to a fundamental difference in how the two countries decided to build their banking systems. In America, the model was one of small, local, fragmented banks. This was known as unit banking. Practically every town had its own independent bank. The problem, if one of these small banks got into trouble and failed, there was no larger network to save it. It was a system built like thousands of tiny, individual dominoes, all just waiting for the first one to fall. Now, let's look at Canada. They took a completely different approach. Canadian banks were national from the very beginning. They operated across the entire country, with hundreds of branches spread throughout different provinces. This model was called branch banking. Think of it like a resilient network, not a collection of isolated islands. If one region's economy collapsed, say, due to a crop failure or a local industry downturn, the bank as a whole could absorb the shock. Profits from healthier regions would keep the entire system alive and stable. So, while America was building fragile, independent banks, Canada was building financial shock absorbers. This structural difference led to a profoundly different culture. Over time, Canadian banks developed a very specific reputation. They weren't flashy. They weren't particularly risky. And they definitely weren't addicted to wild speculation. While American banks were constantly chasing high-risk, high-reward loans to maximize their profits, Canadian banks were playing a much longer, safer game. They consistently kept higher capital reserves, meaning they had more cash on hand to cover potential losses. They enforced much stricter lending standards, making sure that the people and businesses they loaned money to were actually able to pay it back. And most importantly, they avoided the kind of extreme leverage that made Wall Street so vulnerable. In essence, Canada consistently chose long-term stability over short-term profit. And that single decision saved it from disaster, over and over again. Here's where it gets even more interesting, and maybe a little counterintuitive. Canada has far fewer banks than the United States. But the banks it does have are larger, older, and significantly harder to kill. To give you some perspective, at one point in history, the U.S. had over 10,000 different banks operating at the same time. Canada, during that same period, had fewer than 100. This concentration, often criticized in other industries, had some huge benefits for the financial sector. It created stronger, more recognizable financial identities. It made federal regulation much simpler and more effective because regulators only had to oversee a handful of major institutions instead of thousands of tiny ones. And it reduced the frantic, internal competition that often pushes banks to take on increasingly risky loans just to get an edge. In America, when a bank failed, the whole institution collapsed. In Canada, if a single branch failed, it was just a small part of a larger, healthier organization. It meant restructuring and reallocating resources, not financial death. The ultimate test of these two opposing systems came in 1929. With the onset of the Great Depression in the United States, the banking system completely shattered. Over the next few years, 9,000 banks failed. Millions of people lost their life savings overnight. The nation's money supply shrank dramatically, and unemployment skyrocketed, paralyzing the country. But in Canada, the story was completely different. There were 0 major bank failures, not a single one. And here's the most incredible part. At that time, Canada didn't even have a national deposit insurance system, the kind of government guarantee that protects your savings today. It wasn't officially established until 1967. Why? Because for the most part, its banks didn't need saving. Canada had built a fire-resistant system in a world that was made of paper. Fast forward nearly 80 years to 2008. The world was on the brink of financial Armageddon. The subprime mortgage crisis in the U.S. broke the bones of Wall Street. Lehman Brothers collapsed. AIG, Bear Stearns, the biggest names in finance were on life support. The American government responded with unprecedented measures. The $700 billion TARP bailout, massive emergency lending from the Federal Reserve, and huge government stimulus packages just to keep the economy afloat. And what happened in Canada? The miracle repeated itself. Not a single Canadian bank collapsed. No government bailouts were required. In fact, Canadian banks remained profitable throughout the entire crisis. While the world's financial system was melting down, Canada's just kept on working. The international community looked on in awe. The World Economic Forum called it the soundest banking system on the planet. Many simply called it the Canadian banking miracle. So why is this incredible story so often forgotten? Why don't we hear about it more? The simple answer is that Canada never bragged. There are no blockbuster movies about Canadian bankers. No larger-than-life billionaire celebrities from Bay Street, Toronto's equivalent of Wall Street. No explosive scandals that grab international headlines. Canada built a system that just works. It works quietly, efficiently, and without drama. And in a world that seems addicted to chaos and crisis, stability just doesn't make for exciting news. So let's quickly recap what makes Canada so different. It comes down to 4 key factors. First, the banking structure. The U.S. chose a fragmented system of unit banks, while Canada chose a unified system of branch banking. Second, the number of banks. America historically had thousands, while Canada had less than 100. This made Canadian banks bigger and more resilient. Third, the culture. American finance often chased high-risk, high-profit strategies, while Canadian banking culture has always been more conservative and focused on stability. And finally, the results speak for themselves. During the Great Depression, the U.S. saw over 9,000 bank failures. Canada had 0. In 2008, the U.S. needed massive bailouts. Canada needed none. Canada didn't just survive financial crises, it engineered a system that was largely immune to them. In the end, Canada proved something truly shocking. Financial stability isn't a miracle. It's a choice. The world keeps asking, again and again, how do we prevent the next financial crisis? Maybe the answer isn't louder markets, bigger risks, or more complex financial products. Maybe the answer is quieter markets, because sometimes the safest banking system in the world is the one nobody talks about. Thanks for watching. If you found this story as fascinating as I did, don't forget to like and subscribe for more.